Imagine this. It's 1998. The internet is exploding. New companies are popping up every day. Everyone's convinced they've found the next billion-dollar idea. And you throw all your money into a handful of tech stocks just because they've got flashy .com names. For a couple of years, your money only goes one way, up. People start calling you a genius. Until the year 2000, when everything falls apart. The NASDAQ crashes nearly 80%. Most .com companies disappear overnight. I watched friends lose millions instantly. And even though I saw the warning signs, my own investments still took a hit. Why am I telling you this? Because that same energy is back. But this time, it isn't the internet. It's AI. People are calling it a once-in-a-lifetime opportunity. Maybe they're right. Or maybe we're about to repeat the same story again. History doesn't repeat, but it rhymes. And every generation says the same thing. This time, it's different. But is it really? Since millions of you started investing because of my videos, I feel responsible to give you my honest take. So before you panic, let's break down the 3 hidden forces behind this potential bubble, why they matter, and how you can protect yourself or even profit from the chaos. Right now, the entire stock market is being dragged around by just 7 companies: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. The Magnificent Seven. Together they make up over 1/3 of the S&P 500, and they're all in a brutal arms race to dominate AI. Even if you own just one index fund, you're already betting on these companies. Your future returns depend on how this race plays out. And when you see how much money they're pouring into AI this year, it's insane. Tesla, $5 billion. Apple, $10.7 billion. Meta, $60 billion. Google, $75 billion. Microsoft, $80 billion. Amazon, $100 billion. That's $330 billion in 1 year. More than the entire GDP of Finland. And here's the scary part. This AI spending is basically what's keeping the U.S. economy alive right now. Without it, we might already be in a recession. Global AI spending is expected to hit $500 billion by 2026. Power demands? $3 trillion a year by 2030. That's how desperate companies are to win this race. Because this isn't just a corporate war anymore, it's the US versus China. Whoever wins AI wins global power. But the big question is, where is all this money coming from? Enter the AI money machine. And this is where things get crazy. Chip makers like Nvidia sell chips to everyone. OpenAI, xAI, Google, Microsoft, Amazon. Those AI companies buy chips using money invested by the same companies selling them chips. Then those investors record revenue, stock prices go up, and the cycle continues. It's like I pay you $1,000 to dig a hole. You pay me $1,000 to fill it back in. We both report $1,000 in revenue, and somehow our business is valued at $40,000. This loop is inflating the entire AI industry. Nvidia is the biggest winner. Stock up 1,600% since ChatGPT launched. They sell the shovels, data centers provide the land. OpenAI digs the quarry, and together they entice investors into the mine. Even though nobody's found gold yet, OpenAI is valued at $500 billion while making around $12 billion in revenue and losing money every month. So the big problem isn't talent or technology, it's profitability. But could AI companies eventually make massive profits? Yes. ChatGPT alone has 700 million weekly users. Imagine ads. Imagine product recommendations. Imagine industries becoming dependent on AI with no choice but to pay whatever the price is. There's huge potential. But all of it assumes one thing, that AI progress keeps accelerating, and that's where we hit the data wall. AI is running out of high-quality data. By 2027, it may have consumed almost all public online content. Progress could slow, expectations could crash, and the bubble could burst. Unless AI companies figure out how to learn from new types of data, the way humans learn from real experiences. So, is this another dot-com bubble? Not exactly. Today's AI companies actually have real products, real utility, and a real chance at profitability. But the warning signs, they're hard to ignore. Overvaluation, revenue loops, geopolitical hype, logic-defying expectations. So, what should you do? Here's what I'd focus on. Number 1, keep investing regularly. If we're early in the bubble, today's prices will look cheap later. Automatic monthly investing into low-cost index funds protects you from timing mistakes. Number 2, grow your income. Your income is your fuel. More income means more investing power, especially during crashes. Number 3, diversify. Don't bet everything on AI. My portfolio includes stocks, bonds, gold, real estate, and even crypto. Dividend stocks also help during downturns. Remember, if a bubble bursts, it's not the end. It's an opportunity. The people who stay calm, stay consistent, and understand what's happening, they're the ones who end up winning great. Now, I would be creating this video with stock footage and images, so also suggest me relevant stock footage options for each scene.